Hello everyone. In this video today, we're going to be going through the topics of the LIFO retail method and then the dollar value LIFO retail method. So basically these are two additional retail inventory methods that we have not covered yet. These are the last two that we have. And again, what I mean by that is that there's been a couple of videos. There's been one on the basics of the retail inventory method. And there's been one on the LCM, the lower of cost or market or conventional method, and the cost method. Okay, and so before watching this video, you really should go back and watch those other videos because the ordering is important, because a lot of the stuff I'm going to say here, I'm going to go through it somewhat quickly just because I am somewhat assuming that you have that knowledge, just because if I go through every single thing again, it's just going to make the video unbearably long, and I'm trying to condense it as much as possible. Okay, so make sure you've seen those videos before, and if you do, a lot of these things that I'm going through quickly will make complete sense. Okay, so first, the LIFO retail method. Companies that adopt this retail inventory method do so because of the tax advantages inherent in LIFO. Again, LIFO has tax advantages because generally speaking, you're costing out the most expensive items first, okay? Which means it's going to lower your taxable income and reduce your taxes, okay? Both markups and markdowns are included in the cost to retail ratio. Both are above the line. We'll see that in a problem in a minute. This uses the concept of LIFO layers and looks for increases or decreases in inventory from year to year. Again, we've talked about the concept of LIFO layers in previous topics, and basically LIFO layers, you build them up each year, and then maybe they go up, maybe they go down as time goes on, okay? And we're looking for increases or decreases in that layers. So basically, this method assumes that markups and markdowns only apply to the purchases of current period and not to beginning inventory. So that means that we must separate our beginning inventory from everything else that happens during the year, okay? This also means, and this method also assumes that selling prices of inventory are stable and are not changing over time. Again, not necessarily the most reasonable assumption, but it makes our lives easier if you're told to do one of these problems versus one of the ones at the bottom. These are actually easier because we're assuming something that is, which says that selling prices are stable. Okay, so we don't have to deal with any price indices. Okay. Also, it utilizes separate cost to retail ratio for each LIFO layer. Okay, and we'll see what that means in a minute. So each LIFO layer is going to have its own cost to retail ratio. Okay, the dollar value LIFO retail method, everything about this method is the same as the one above, except for the fact that this method assumes that selling prices of inventory are not stable and are changing over time. It makes things much more complex, and it's dollar value LIFO but more fun, depending on what your definition of fun is. Okay, so the main difference from the LIFO retail method is that this method has a price index each year in addition to the cost to retail ratio. Okay, so we end up adding in this thing about the dollar value LIFO method that we've covered, which everyone loves, right, so much, and this idea of a price index on top of the cost to retail ratio. Okay, so these calculations are pretty complex, and it's easier to just go through some examples. So let's go ahead and jump into some examples. Okay, so let's just go ahead and get the facts of the problem set up next to the solution itself so we can see everything we need to see here. Scoot that over just a little bit. Okay, it looks pretty good. Okay, so basically we have this ABC company. They're a retailing concern that sells a myriad of different items. The company uses the LIFO retail inventory method to account for cost of goods sold and the value of its ending inventory. As of December 31, 2017, the company has the following information related to its inventory. Okay, then we're given all these items, we're given the cost, and we're given the retail value. Okay, and if you've watched previous videos, all of this information should look pretty similar. A lot of these facts are literally the exact same facts as other problems. Some of them are tweaked a little bit, but most of them are literally the exact same thing. And then again, we're asked to prepare a schedule to determine XYZ company's ending inventory and the cost of goods sold for the year ended December 31 using the LIFO retail inventory method. So here we have our solution. A lot of this stuff we're just going to kind of blaze through because we've seen it in previous videos, and we don't need to belabor the point too much, okay, but we'll go through a couple things and highlight, okay? The first thing we want to highlight is that beginning inventory is by itself, okay? We have these lines. We have our own separate cost to retail ratio for beginning inventory, like we talked about on the previous page. Okay, beginning inventory will have its separate cost to retail ratio from everything else that happens during the year, okay? So then what happens is we first have beginning inventory by itself, 40 and 60, it tells us right there in the problem. So we just make our chart, and it's 67%, right, rounded as our cost to retail ratio. Then we literally just plug in everything such as purchases, freight in, purchase returns, purchase discounts, all these items, right? So purchases are right here, 100 and 180. Freight in is at the bottom here, 5,000. Purchase returns are 3,000 and 4,500. Purchase discounts are 2,000. Then we have markups. and markdowns. And again, as we talked about, this method, both markups and markdowns, it's the second item here, both markups and markdowns are included in the cost to retail ratio. Both are above the line. Okay, so that means that all these items, markups and markdowns, are all included in the cost to retail ratio. So markups 5,000 right there, markup cancellations 2,000, markdowns 4,000, markdown cancellations 1,000, and then we have abnormal spoilage, which goes above the line, 4,000 and 6,500. And again, why are all these items above and below the line? Well, we can refer back to our chart here from the basics video for retail inventory method. And again, as I say in that video, and even maybe the other video that we had in this topic, this is one of the few topics in this class where the FASB just made the gap on this, and some of these items, why they're above and below the cost to retail ratio, it doesn't make a ton of sense conceptually. It's just that that's what the FASB has told us to do. And so this is one of the few areas of the class where you kind of just almost have to memorize this chart and know exactly where these items go and whether they're included in the cost column, whether they're included in the retail column, and whether they go above or below the cost to retail ratio line. Okay. Then what we do, after we've done all this, calculations at the top, we come down to goods available for sale. Now this excludes the beginning inventory. Okay, if we were to add up just these numbers and then just these numbers here, we would get to these numbers. And that gives us our cost to retail ratio, our second one for the current year. So we have one for the previous year, and then we have one for the current year. Okay, so remember, we keep them separate with the LIFO retail method. Okay, that's the biggest difference between this method and other methods. Then we want to just total up everything, which means 178 plus 60 to get to 238 because we're going to need that later on. Then sales revenue is 90. It tells us that right there. Sales returns we subtract out. We end up with 83,000. And then normal spoilage is 6,000. Tells us that right here. Okay, we come down to $149,000 ending inventory at retail. Okay, and so everything here should seem very familiar to the other videos. And again, we want to make sure that we're subtracting the revenue at the gross amount. That's why we're ignoring the discounts here. We went over that extensively in the other video. So if you wanted to review that, you can go back and look at that again. Okay. So now we just want to look at this second page, and then we'll be done with the LIFO retail method, and we'll just have one more method to go. So let's just make sure that we have everything showing. All right, perfect. Looks good. All right, so we have LIFO ending inventory at retail. Okay, that's told us right here, 149. So it's 149. We're just moving that over. Then what we want to do is now we want to do our LIFO layers. Okay, these are basically LIFO layers here. Okay, so basically what we want to do is we want to take this 149 at retail and we want to compare it to the beginning inventory at retail. And we want to see, is there an increase or there's a decrease? Well, there's clearly an increase, right? Because it's 149 at the end of the year and it started off at 60. So that means there's an increase. How much is the increase? Well, it's 89,000. It's just 149 minus 60. So that gives us 89. Okay, that means we build up a LIFO layer in 2017. Okay, our last step after doing this calculation is to say, okay, 60 times the separate cost to retail ratio of 67% gives us 40,000. That's our ending inventory at LIFO cost. Then we take the 89,000 that we built up this year, we multiply it by the 60% ratio for this year, gives us 53,000. That gives us our ending inventory at LIFO cost. So this is actually the ending inventory cost. Okay, last step, calculate cost of goods sold. Beginning inventory plus purchases minus ending inventory gives us our cost of goods sold. Okay, and again, all of these numbers are reviewed where they come from in the previous video. We'll go over it very quickly here, but it's 40 is from here. The 100,000 of purchases is 100,000 plus 5,000 of freight in minus 3,000 of purchase returns minus 2,000 of purchase discounts give us net purchases of 100,000. The 93,000 is from here. The ending inventory at cost, that gives us $47,000 of cost of goods sold. Okay, again, the main thing to remember here is that we want to compare this ending inventory at retail to the beginning inventory at retail. If we have an increase, we build up a layer, okay, and we cost that new layer at this cost to retail ratio for the current year. And then we do and we also have the beginning inventory at the cost to retail ratio from the last year. Okay, now really quickly, if this number was lower than the first number, what would we do? Okay, let's say we had like $40,000 ending inventory at retail. Well, the way that would look, we would have a 2016 layer, and then our 2017 layer would be 0, okay, because it went down, right? And all we would have is $40,000 for 2017 at 0.67%, and that would give us our ending inventory at LIFO cost. So whatever that value would be, we could do the math really quick. It's about $26,800 rounding, okay? And that would give us our ending inventory at LIFO cost. So if it goes up, we build up a layer. If this value at the end is higher than the beginning, we build up a layer. If it's lower, such as 40,000, we just eat into the previous layer, and we don't have a next layer. Okay, this idea of layers is also discussed in other videos that we've gone over before as well. Okay, so that's basically the end of the LIFO retail method. Now let's look at the dollar value LIFO retail method, and then we will be done with this topic. Okay, let's make sure that we have everything on the same page here. This is going to be very quick because this is literally because this is a very similar problem as before. Okay, we have ABC Company is a retailing concern. They sell a myriad of different items. The company uses the dollar value retail inventory method to account for the cost of goods sold and the value of the company's ending inventory. Assume that the price index for 2016 was $1 and that the price index for 2017 was 1.65555. As of December 31, 2017, the company has the following information related to its inventory. This right here should say 180. That's the only thing that I can see that I was switching around a couple of things, and just this should be 180. Okay, other than that, everything else looks good, but just to note that really quick, that should be 180,000 for the purchases. Okay, so then it says prepare this schedule to determine XYZ company's ending inventory and cost of goods sold for the year ended December 31 of 2017 using the dollar value LIFO retail inventory method. Okay, so now we're using dollar value LIFO retail inventory method. Okay, now if we read through these facts, again, this should be 180. So other than that, the only change between this problem and the previous problem we just looked at for the regular LIFO retail method is that we have this price index information. Every single thing else in this problem is literally the same numbers. Okay, so we're going to go through this very quickly, and then we're going to go through the next page a little bit slower because that's the new part, okay? We don't want to spend a ton of time here because we've already seen this, right? Like, we're literally just repeating the same things, okay? Again, you keep beginning inventory separate from the current year, okay? So you have a cost to retail ratio for the current year, for the beginning inventory, and then you have a cost to retail ratio for the current year, okay? Everything else within here is literally the exact same. Okay, you have your purchases, you have your freight in, purchase return discounts, markups and markdowns are both above the line for dollar value LIFO. Okay, then we come down to our goods available for sale. We have our total inventory, including beginning inventory. Then we have our sales revenue come out, and then our normal spoilage come out. Ending inventory at retail is 149. Okay, this should seem very familiar because it's literally the same as before. Okay, now we want to look at the changes, and then we'll be done. Okay, this is the hard part, and we want to just go through this a little bit slower, okay? So ending inventory at retail is 149. Again, that's just given to us. Well, it's not given to us, but that's where it's coming from, right? That's where we're getting that number from. We solved for it, but okay, right. So then what we need to do, the first thing we need to do is, if we can remember back to dollar value LIFO, what we do to get to ending inventory at base year prices, this would be ending inventory at retail at end of year prices, right? So what we need to do is that we need to take this 149, and it tells us that our price index for the current year was 1.6555 repeating, okay? And we need to divide by that price index to get to the ending inventory at base year prices, okay? Because the reason we're doing that is because we want to be able to compare apples to apples. This $60,000 is the base year inventory, and it has a price index of 1, okay? It was told to us in the problem, okay? And so this 60,000 is already stated as of the base year. This 149 is not stated as of the base year. To get it stated as of the base year, we take out any price increase effects by dividing by the price index for that year, for 2017 in this case. So we divide by 1.655 to get to 90,000. Again, this is taking out any effects of inflation, and we're trying to just measure, is there an actual increase in the quantity of inventory as opposed to, well, yeah, there's an increase in inventory, but is it because of price increases or is it because of quantity increases? Because if it's just increases in price, then we don't care about that as much, right? So then we go to $90,000 here, okay? Then what we do after that is that we compare this 90,000 to the previous year at base year, okay? So we have ending year at base year, okay? And then we have beginning inventory at base year prices. Okay, and that was $60,000. Why is it 60? Because it's 60,000 divided by 1.00, okay? And that would be $60,000, right? Okay, so if we compare 90 to 60, we see that it increases by $30,000, right? So we build up an additional layer of 30,000. Okay, so then we just do our math, okay? We have our 2016 layer at 60. Then what we do is we have to multiply by 2 items now. we multiply by the cost to retail ratio, then we multiply by the price index. For the 60,000, okay, it's the beginning inventory. The cost to retail ratio is 0.67. The price index was given in the problem. It was 1.00. Okay, we can flip back to that very quickly here. Okay, it's 1.00 for 2016. Okay, then for the next year, we have a cost. Then we have, again, we build up a layer of 30,000 in 2017. That's the year that we're in right now. The cost to retail ratio is 0.6. It goes there. Our price index is 1.655, whatever. It's just rounded there. And then we get our ending inventory at cost once we multiply across for both of those. Okay, we add them up. We add the 40 to the 29,000. We get 69,577. Then we can solve for our cost of goods sold. Okay, so cost of goods sold, again, beginning inventory, we add our purchases, we subtract our ending inventory, we get $70,000, $70,429 for our cost of goods sold. Okay, so just to review here, basically the steps are that we do all our calculations in our chart, okay? We make sure that we keep our beginning inventory separate from our current inventory, okay, to get our two different cost to retail ratios. Once we have our ending inventory at retail, we're gonna divide by the price index for the current year, okay? That's gonna give us the ending inventory at base year prices. Then we compare that to the beginning inventory at base year prices. Once we do that, we determine if there's an increase or a decrease in the actual quantity of the inventory, because we're comparing apples to apples. We're comparing inventory at base year prices to inventory at base year prices, right? Which is apples to apples comparison. Here we see there's an increase in the inventory, which means we build up a second layer. So we have 60,000 plus 30,000 equals 90, right? Then we just multiply by the cost to retail ratio and the price index for each year. That gives us our ending inventory at LIFO cost. Then we use our little cost of goods sold formula, which we've gone through multiple times at this point. Only thing that changed was this number, which means our final number is a little bit different for cost of goods sold. So that's the end of this topic. I know it is a little bit challenging. Going through this topic a couple times might be helpful just to get the hang of it. But honestly, a lot of this stuff, like I've said in a couple videos now, I think I maybe said in this video, this is one of the areas where there's some weird things going on, but again, you kind of almost have to memorize your way through these problems and the steps, because some of it makes sense, yes, for sure, but there's other parts of it where you kind of just almost have to memorize the process because it doesn't make a ton of sense, okay? And so basically, that's the end of this topic, and I hope that was helpful.